Next, you'll discover the difference in trading strategy between Fat Cat funds and smart neighbours. Let's start with annual profit. I've already said that the Fat Cat fund averages 5% profit long term. During a market peak, it may make over 20%, and in a crash, you'll lose about 50 to 90%. In contrast, you see I average 84% profit on Twitter. I plan for over 200% profit during market peaks, and I'd range from 55 to 105% annually over the last 4 years in a slump. A smart beginner should expect 7 to 10% annual profit in a slump and 20 to 30% in a boom. So smart neighbours beat the fat cats, making 17 times more profit, which leads us to investment timescales. Fat cats brainwash you with a long-term strategy because they want your fees. They always promote hold for the long term and never mention selling. Their propaganda trick makes you forget about selling and taking profits because they want to keep you as a loyal customer for 10 to 20 years to earn fees. On the other hand, smart neighbours operate a short-term strategy. We want profits every month. We profit from quick, short bids. So the entire financial service industry, the media, the government, the regulator promotes long-term, while smart neighbours do the opposite. They invest short-term and make profits even in crashes. Short-term is a far superior investment strategy. This graphic image shows how bad the fat cat's long-term approach has left you. Nothing after 15 years. I've charted the FTSE 100 from 1999, and the reality is that the index is lower now than it was 15 years ago. Plus you see 2 stock market crashes a few years apart. We've had a massive double-dip recession, but no one's shown it to you like this before, and we're still having a bad time. So there's more financial problems for years to come. Let's compare source of income. Fat cat funds make their profit by taking money from your portfolio, usually 1.5% as an annual fee, regardless of boom or crash. Therefore, fat cats make a profit every year. They make big profits during market peaks and a smaller profit in a crash, whereas smart neighbours can only make a profit by trading. That's buying low and selling high. You see, there's no incentive on fat cat funds to perform at all because there's no performance related fees. The fat cat's hidden agenda is to trap you as a customer as long as possible to earn profits from you. You're brainwashed with the well-known phrase, hold for the long term. Performance goal. Fat cats cover up their poor performance by rating themselves against a sector index in order to look better in peaks and crashes. Here's how they claim, say, 2% success in a market peak and in a crash. During a peak, they claim a 12% profit is very successful because they've beaten their index by 2%, whilst in a crash, they claim a 48% loss is a success because they've beaten the index by 2% against a 50% fall. So they claim they're superior fund managers. This is like doublespeak in Animal Farm. In contrast, the smart neighbours' success criteria is annual return on investment, minimum 80% profit. So 12% profit is viewed as poor during a stock market peak when, say, 200% is achievable, whilst a 50% loss is totally unacceptable in a crash when 80% profit may be earned. The bottom line is smart neighbours set high standards to earn big profits. Now, fat cat funds have 3 main conflicts of interest. They arise from cosy company relationships, subsidiaries opposing views, and investment committees. 1. Cozy company relationships. Fat cat directors have cozy relationships with research firms, pension funds, insurers, analysts, and clients. They all sit on the boards of each other's companies and receive shares as part of their remuneration. These cross-holdings make it hard for a fund manager to sell an underperforming stock when his director sits on its board with his personal stake. Also, directors used to provide for close friends with favoured share allocations on flotation, but this practice, called spinning, has only recently been made illegal. 2. Subsidiary companies. They might have conflicts of interest when one is an investment bank and the other is a fund manager, each with the same client. Thus, the investment bank might promote their client as a sound investment to buy, whilst the fund manager says sell because the company's performance has fallen. This happened during the dot-com boom and BP's Gulf rig explosion. Despite their shares falling 50%, fat cat funds continue to hold them, even though the rules now require Chinese walls to prevent leaks and preserve independence. 3. Investment committees. They approve the stocks that fund managers can buy, and they tend to approve companies which comprise the index or where the directors sit on their boards or are clients of their investment bank. So they usually select big companies like themselves, but often ignore small, fast growth stocks. But smart neighbours are totally unbiased. They can buy and sell any share anytime, especially in small, fast growth companies. So the bottom line is, fat cat conflicts of interest hurt customers like you. Now the industry knows that fund managers are subject to conflicts of interest. Here's a page from the magazine of the Chartered Institute for Securities and Investments. See, it states, there was agreement that investment managers suffer from inherent conflicts of interest. So wise up. Fat cats will keep the status quo and they'll continue to fleece you. It's the fat cats who are in charge of the meat and they'll take the lion's share. Fat cats have no incentive to change. Let's see how duty of care protects shares. You'd expect that fat cat funds, with all their talk of customer care, meeting your investment needs, balancing risk and profit, and being professional experts, that they'd exercise a duty of care over your money to protect your shares from a crash. However, fat cat funds never use stop losses to protect your assets because they don't want to give any hints about selling. They want to maintain their fees and profit. So in a typical stock market crash, you'll lose 50 to 90% because you're told, hold for the long term, don't sell, we're the experts, trust us, buy more shares while prices are low, they'll recover. But you'll have to wait many years just to break even. In effect, fat cat funds win, you lose. In contrast, a smart neighbour always protects his portfolio with a duty of care system and applies a stop loss policy. Because he's not divine nor a time traveller, he expects his big profits will cover small losses. He'll sell shares quickly if prices fall sharply and limit his loss to about 1 to 10%. That's why the smart short-term strategy is safer than the fat cat's, and it boosts profits drastically. As a rule of thumb, about 4 times. Remember, a stop loss is an essential safety net. This is why I said, share profits are safer than you think, and profits are bigger than you think. You owe yourself a duty of care.